Welcome to the latest episode of Quest for Twice. In this episode, I'm going to cover some interesting stocks. These are the FAN stocks. Why? Because the FAN stocks are mega caps and they are market leaders and make a very significant contribution to the S&P 500. So it's important to understand their valuations. So this slide has a lot of information. This let's break down the information. So this table has the stocks listed for each row: Facebook, Apple, Amazon, Netflix, and Google. And there are different columns to consider the key metrics of each company. The first one is a price to sales ratio. The next one is the price to sales ratio range in the last 3 years. The third one is the sales growth rate. It's a compounded annual growth rate. Then a gross margin of each company. And the price over gross earning and their range in the last 3 years. Then I also tabulated the R&D as a percentage of gross earning. And lastly, I gave them a mode rating. So a lot of information. Let's look at the information in details. The first one to look at is price to sales ratio. So what we can see is they are quite different from Apple and Amazon at the low side to Facebook and Netflix at the high side. So it's more informative to compare the current price to sales ratios to the range in the last 3 years. Usually the price to sales range is not too wide. The high ratio usually is double the lower bound. For example, Facebook is from 5 to 11. 11 is 2.2 times of 5. And Amazon is the 4.5 is almost double of 2.3. Google, the range is actually narrower, 8.4. It's less than twice of 4.5. So Apple is the exception. The 8.4 is more than triple of 2.7. If we look in details, we can actually see that in the past, the higher bound is close to 5.4. It's only in 2020 and 2021 the price to sales ratio exceeded the 5.4. So currently it's at 6.6. So the price to sales ratio, what's a good one? What's a reasonable price to sales ratio? That's really driven by the sales growth rate. So Apple actually has the lowest average growth rate in the last 3 years at 6%. Most of the other FAN stocks has a growth rate close to 30%. It is not too meaningful to compare price to sales from one company to another. The key reason is that they have a very different gross margin. The gross margin is basically the sales subtract the cost of sales will give you gross profit, and the gross profit divided by sales will give you gross margin. So for Apple and Amazon, they sell a lot of physical goods, so their cost of sales are higher as a result, their gross margin is lower compared to software companies like Facebook and Google. Netflix has actually lower gross margin than I initially expected. I believe that's because Netflix spent a lot of money to create original contents. So that's considered the cost of sales. So Facebook has the highest gross margin, and Amazon has the lowest gross margin. So I believe the more relevant valuation metric is to look at the price over gross earning and compare that to the range in the last 3 years. So once we do that, we can see that they are actually a lot more comparable from one company to another. For example, now Apple and Amazon have a similar price to gross earning ratio around 17, similarly as Google. Netflix has a much higher price to gross earning ratio, and Facebook noticeably has a lower ratio. So we can also look at the individual company current price to gross earning ratio and their range in the last 3 years. So generally speaking, they are either slightly over halfway or close to the upper bound of their range in the last 3 years. The reason I don't look at the price to earning or enterprise value to EBITDA or cash flow is that the research and development R&D is considered the operation expense, but it is really an investment for future revenue growth. So we can see in this column of R&D as a percentage of gross earning. It varies a lot from one company to another. For example, Apple has the lowest R&D expenditure at 16%, and Amazon spent almost half of its gross earning on R&D. So if we look at the operating income, then that's with the R&D expense subtracted from gross earning, then that operating income is distorted. For example, for Amazon, the operating income is artificially low because Amazon spends so much time on R&D. The last column is a moat, i.e. the competitive strength of each company. I got a rating from Morningstar with some of my own interpretations. For example, Facebook has a wide moat. Its competitors in Twitter, TikTok, etc., don't pose serious threat to Facebook. On the other hand, Apple has a narrow moat. Of course, it has its own ecosystem. It has an excellent product. But the Asian players, for example, Samsung, also make very good tablets and smartphones. Amazon has a really very wide moat, considering the collection of various Amazon products and services. And the Netflix has narrow moat. For example, Disney is a new player to the online streaming business. It quickly signed up almost 100 million subscribers. And so I would say the Netflix moat is not very wide. And on the other hand, Google has a very wide moat because it's a very superior search engine and the reputation among the consumers. So which ones of the FAANG stocks are better investment. So the investment thesis is really to buy a fantastic company at a reasonable price, given that all of them are having or have had excellent growth. At current price, I would not invest in Apple, given that historically it has the slowest sales growth among the FAANG stocks, while its price to gross earning is as high as Amazon and Google. Also, it spent the least amount of R&D, so it's I'm less confident that it will have strong growth for years to come. Also, I would not invest in Netflix because it has the highest price to gross earning ratio at 21, higher than all the other FAANG stocks. Although it grew at a very fast pace in the past, but its narrow mode doesn't provide a lot of assurance that it can continue to grow at the historical rate, considering the new players in the online streaming business. So that leaves us with Facebook, Amazon, and Google as potential candidates. So today I'm going to take a deep dive in Amazon. This figure shows the Amazon sales in the most recent 5 quarters. So year on year, Amazon grow its sales by 40%. It's very impressive. The pie chart shows the contributions to Amazon sales from the three segments. North America about 60%, and the international 28%, and the AWS, Amazon Web Services at 11%. AWS actually is a very interesting segment because it has a very high operation margin at 31%. Compared to Amazon as a whole, the group has only 6% margin. So the AWS is very profitable. It although only contributed the 11% to the group sales, but it contributed 47% of the group operation income, almost half of the income. And in the last 5 quarters, it grew sales by 32% year on year, and it grew operating income by 35% year on year. So it's a very profitable business and growing very fast. So that's a very good combination. So let's take a more detailed view in the segment sales in the last 2.5 years. So a lot of numbers on this slide. Let's focus on the different segments and their year-on-year growth rate, the percentages. So the online sales grew very fast in the last 4 quarters compared to historical growth rate. That can be contributed to the COVID and people shifting their purchase from physical stores to online stores. So we can see that Amazon's physical stores in the last 4 quarters actually suffered the sales decline. Of course, its online sales growth more than offset that decline. And also, the third-party seller services grow very significantly for the same reason that the third party also moved from physical stores to online stores. So given that the vaccine rollout and the COVID cases are declining and the society is returning to normal, and those high growth rate will normalize to the growth rate probably to the similar rates before COVID happened in 2019. There are three segments at the bottom of this table. Subscription services, AWS, we just mentioned, and other. So the other segment is mostly advertisement. What we can see is all three segments grew the sales very fast in the last 2.5 years. It is hard to see the impact from COVID on those three segments, which probably means that even with the society returning to normal, those three segments will continue to grow at a very fast pace. Why is it important? Of course, those three segments have much less sales comparing to the stores and third-party services. However, as I mentioned earlier, AWS has a very high margin compared to the stores. And similarly, subscription and advertisement also have a very high margin, although Amazon doesn't provide that information. But it is very clear that those three are high margin business and growing at a very fast pace. And they are less affected by returning to normal of the society after COVID. So those segments will drive the future profit growth. So the investment thesis in Amazon is clear. It is to buy a growth company at a reasonable price. The future overall sales growth may slow down with society returning to normal and people buy more goods from the conventional physical stores. But the earning growth is sustainable because of the very fast growth of the three high margin business that is less relevant to COVID and returning to normal. So the key indicator for the future will be the gross margin, which should rebound because Amazon had about 4 billion COVID-related cost, which will dissipate in 2021 with the society returning to normal. But more importantly, it is that the three segments with the high margin will grow their contribution to Amazon. As a result, they will raise the overall gross margin. So the risks is Microsoft or Google may take market share away from AWS, then slow the growth of AWS. And also the future growth of subscription and advertising sales may become less than the historical trend we saw on the previous slide. Another risk is that Amazon may make a wasteful investment in mergers and acquisitions through R&D. Of course, there is no evidence for that because Amazon had a stellar historical ROIC, return on invested capital, at 12%. And that's without the adjustment for R&D, which in accounting is expensed, but those should really be considered as an investment. So without the adjustment, the Amazon's return on invested capital is already very high. Another risk is antitrust litigations. So those are the risks to Amazon's business, which are a lot more important than the Amazon stock price risk. But I do want to mention that the current price to sales ratio of 3.9 is about 10 to 15% higher than the average prior to COVID. So as overall, S&P 500 has a high PE ratio. So the market overall has some froth, and Amazon's stock price is also higher than its historical average measured in price to sales ratio. So it's possible that there will be short-term pullbacks. But as long as Amazon can continue to grow its revenue and gross earning, then short-term price pullback will be actually good buying opportunities. Thanks for watching the latest episode of Quest for Twice. Until next time, happy investing.